Hi guys, welcome back to my favorite channel. Okay, right now I want to say about when the property is sold, the deductions will be. Well, the depreciation deductions allows you to recover cost and reduce your income for a given tax year. When the property is sold, the deductions will be recaptured and taxed. Remember from chapter 1 that capital gain is the difference between the net sales price and the adjusted basic. Taking depreciation deductions reduce your adjusted basic. Over several years, this can significantly reduce the adjusted basic of the property, which means more gain. That might not be so bad if the entire amount of gain was taxed at a 15% capital gain rate, but the portion attributable to recapture of real property depreciation is taxed at the substantially higher rate of 25%. Since taking depreciation is required by the IRS, there is no way to avoid its recapture in a taxable transaction because there is no way to avoid recapture of depreciation on taxable transactions and it is taxed at a high rate. It is critical to factor in into your investment analysis and strategy planning. Imagine a scenario where you have been depreciating a property for 10 years, but due to a downturn in the market, you are not able to sell it for much more than your purchase price. You may not have any profit, but you will still have to pay a tax bill on the recapture of depreciation. This There is one strategy for avoiding depreciation recapture. Exchange the property in a qualifying like kind exchange covered in chapter 7 where the basic and depreciation will be carried over to the next property and there is no realization even to trigger capital gain tax. Sales to related parties. If you sell or transfer real property with passive losses to a related party, basically any family member or descendant, suspended losses cannot be deducted until that person sells or transfers the property to an unrelated party. Closing notes on depreciation. The depreciation deduction is an especially effective tax tool for real estate investors. This is because it is not an out-of-pocket cost like other property expenses such as utilities, insurance, and management. To make it even better, even though real property normally appreciates, the depreciation deductions does not depend on actual depreciation. There are some limits, however, only part of the value of most real estate can be depreciated because land is typically part of the value of a property and it is a non-depreciable asset since it does not wear out. Ultimately, the amount of the depreciation deductions you can take depends on the at-risk rules and passive activity loss limitations. A few more notes to close this chapter are listed on the next page. When calculating depreciation, the IRS establishes the useful life or recovery period for different asset classes. The recovery period for residential rental property is 27.5 years, and non-residential real property is 39 years. Real property depreciation can significantly reduce your taxable income for a given year, but it will be recaptured and taxed at 25% when you sell the property in a taxable transaction, so plan accordingly. Okay guys, until here first for today. See you in the next video. Say bye bye. Bye.